Well, it looks like the Feds are going to be raising interest rates again, but why might that actually lower mortgage rates? We're going to talk about that today and give you a little bit of an overview on how that really works. The first thing we need to talk about is inflation, because that's one of the big reasons that rates are going up. So the core inflation numbers came out last week, and inflation was down a little bit, but the core inflation number, the one that strips out food and energy, was actually up 0.1%. So inflation hasn't gone away yet. It's kind of here to stay. And Fed Powell, his job is to help keep inflation in check. And so that's what he's doing with the Fed funds rate by raising the Fed funds rate, trying to slow the economy down a little bit. He's actually trying to help inflation. And that's why you might see in some cases where the Fed funds rate goes up, and at the same time, mortgage rates go down. That's not always the case, because sometimes the news that Fed Powell delivers, it's not good for the stock market or mortgage bonds, either one. That's what we got last week. There was a little bit of uncertainty about whether he's going to raise the Fed funds rate again in December. So it's pretty much a given he's going to raise it in September and then again in November. But there's also talk that he may also be raising it in December, or he may not. That's why the bond market really didn't like that. Let's take a look and see what's been happening in the bond market this week. If you take a look, you're going to see that I made a little triangle here of what we call a pennant. And bonds were trapped in this pennant formation. And what happens when you get to the tip, they can either break out up or down. When bonds go down, mortgage rates go up. And that's what we had, was a continuation of the long-term trend for rates to continue to go up a little bit. But here's an important thing. We have a little level of support right here. And if we can keep that and bounce back off, we might see rates stay in the low fives. However, you see right here, we break out again below this level, we could see rates getting back up to 6% pretty quickly. So that's kind of what we're faced with rates in the near term. So let's take a look at rates and what's that going to do to housing prices. Well, most people think that if rates get back up above 6%, that could slow things down a little bit. So we're going to try to take a wait and see attitude, see what happens with interest rates. And if they stay in the low fives, I think we're going to see a pretty strong market through the rest of the year. And I don't think we'll see home prices drop very much if rates stay in the low fives or even lower. However, if they get up to 6%, we could see that pressure start to push home prices down just a little bit. And of course, they're going to be pockets. You're going to see some areas further out that might start seeing a little bit less price competition. Therefore, they might start dropping prices a little bit. But if you're in a really hot area in a really good school district, you're still going to see a lot of pricing pressure on homes because there's just such a huge demand and still quite a little bit of a limited supply. That's our update for today. I'll be back in touch again. Stay tuned. Be sure to like and share. Thanks a lot.